Hello and welcome to our latest Insider interview. Today in the studio I have with me Stephen Yu, who is the fund manager of the Blue Whale Growth Fund. Stephen, thank you for joining me today. So Stephen, you aim to find the highest quality businesses at an attractive price. So how do you go about doing that in practice?
So the way that we do it is we do all the research in-house. So we don't use any sell-side research. We don't speak with sell-side analysts. And there are 5 of us on the investment team. And we just go through all the primary sources that we can get our hands on in terms of information, from annual reports to transcripts, conferences, looking at competitors and trying to get a good feel about how the quality of our business is. And at the same time, after we've done all the research, we would translate our understanding of the business into a unique financial model. And that's when we then make forecasts in terms of how much money this company would make in the next couple of years. And then that's how we gauged whether the valuation of this company would be attractive. And I think the other thing which probably differentiate us a little bit is we run a high conviction portfolio of about 25 to 35 stocks. On average, is about 25 stocks in the fund. And there are 5 of us doing that. So if you just do it mathematically, that we just ended up spending a lot more time looking at the company we have in the fund versus some other team that might have less resource or covering more stocks.
Since the fund launched, which was just over 5 years ago, you've outperformed your average peer in the global fund sector. But the past year, it has been a more challenging year for performance. Could you explain why fund performance has come off the boil in 2022?
Yeah, I think this year's performance has been quite disappointing from our perspective. But to put it in context, I think out of the 5 years that we've been running the fund, the first 4 years was very good, and then this year has been very disappointing. Of course, if you marry the level of underperformance this year, then it has probably eaten away a lot of the outperformance that we generated in the first 4 years. But I would probably categorize this year to be like a normal year because of the interest rate cycle to be going up quite quickly this year, from the beginning of this year until today, on the back of high inflation, on the back of the Ukraine crisis and all that stuff. And I would see this year as a bit similar to the pandemic year. That is probably not a repeatable year. So unless you believe that interest rate cycle is structural, not cyclical, which means that interest rate just forever keep going up, then it's probably not a good place to invest into equities or any asset classes to start with. We don't believe that. We believe that interest rate cycle is cyclical. So at some point, the interest rate is going to stop going up. At some point, if we do go into recession, then interest rate would start coming down. So basically what it means is, if you look at the valuation of many companies, including the ones that we have got in the fund, of course, there's been a big reset in multiples this year because interest rate has gone higher. So even using Microsoft as an example, Microsoft shares has gone down about 25% year to date. But the quality of Microsoft and also its earnings growth trajectory in the coming years still very much intact. So we do believe that there's a good proportion of this 25% reset in share price this year they would be able to recover that in the next few years, despite a high level of interest rate. So I think what we hope people would do is, if our investor can take a medium-term view, I think they are very well positioned from here that we should be able to recover quite a lot of the losses in the next coming years.
As you just mentioned, the fund performance in 2022, it has had an impact on the longer-term numbers. And if you look at how the fund has fared versus the MSCI World Index over 5 years, both have returned a similar amount. So are you confident on a 10-year view that you'll outperform that index? And how would you try to convince an investor to back you as an active fund manager rather than just simply buying the global market through an index fund or an ETF?
Yep. So firstly, that we are committed to deliver significant outperformance versus the market. So MSCI World Index would be one of those, and iGlobal sector average would be another one. And that is how we decided to set something up 5 years ago. And the way that we go about this is, we do recognize that the market is very efficient, and hence there's a lot more money going into passive trackers or ETF in the last 5 to 10 years. And of course that has continued recently as well in terms of that trend. But what is really important is if we can run a high conviction portfolio, being very focused, investing into 25 to 35 companies versus the MSCI World Index, which has about 1,500 companies. And if those 25, 35 companies are better than the 1,500 combined, then the potential for outperformance would be a lot higher. But I think what you have seen this year, from our perspective, is the level of underperformance has equally been magnified because of the interest rate cycle in terms of the valuation reset. And when you're running a highly concentrated portfolio, when you're not doing well, you would be even worse off in a negative environment. But I think if you take a medium-term view, if you can get it right, if your research, you have done enough research that proved to be right, and you can have a repeatable investment process that can continue to deliver alpha time and time again, then we should be able to do better than the market. Because ultimately, this is the question that active managers like ourselves need to be asking, is whether we can do better than the passive tracker. Because if the answer is no, if there's no way or no chance that we can ever do that, then that we don't need to have active managers in our market. I think the last point I would make is we are a big backer of passive tracker. Of course, we need to do better than them to justify our fees. But then I think that makes the market very competitive, and hence we do work very hard to try to deliver that.
In terms of the portfolio, one of the big changes in recent years is the fact that you no longer have exposure to the FANG stocks, which are 5 of the most famous tech companies in the US. Could you explain why you sold out of those companies?
Yeah, so throughout the 5-year history that we have never invested into Netflix, which we deem as quite a low quality business, and I'm sure people would have seen that at the moment now, given the inflation narrative, that consumer disposable income being squeezed, that there's a lot of churn in terms of you might subscribe to Netflix for a few months and then you go to HBO's or Now TV or other places for another few months. So the recurring revenue stream is never that sticky. So Netflix is something that we never consider. But in terms of the stocks that we actually invested into throughout the last 5 years would include the likes of Amazon, Google, and Facebook. And they come in different shape or form in terms of the investment thesis. So as far as Facebook is concerned, that we exited that quite early this year. We have held that for about 5 years, 4.5 years until that point. But the thing with Facebook is a lot more company specific, that they have seen increased competition from TikTok, which wasn't the case a few years back. And of course, if you recall, Donald Trump was trying to ban TikTok in the US. If that was successful, then Facebook would not have seen the competition that they are now seeing, because TikTok is actually quite a robust technology in terms of recommendations, and teenagers do spend a lot of time on TikTok. And then secondly, on the back of the changes in iOS 14.5 by Apple and also followed by Android system, that it makes Facebook more difficult to target audience like before. So it's more difficult for them to get our data now compared to a few years back. So then it means that advertisers would be spending less money on them because the return on investment is a lot lower compared to before. The last but not least, which we think is a deal breaker for us, is Zuckerberg's commitment to go into the metaverse. So personally, I am a believer in metaverse in time. It might take 10 years, it might take 20 years, it might even be longer for us to have this conversation in the metaverse in many years to come. But the problem for Facebook or Meta to go about this is it's not clear that all the money that they spend into this arena is going to be translated into profit, because you could expect at some point, or already maybe in the pipeline, that Google, Microsoft, and Apple is working on some shape or form of a metaverse. So what if all this money that Zuckerberg spent in the metaverse ended up to be one of the many players, just like Netflix, that you have many other alternatives? Then the return on invested capital profile for this investment would be a lot lower than if you're the dominant leader. At the moment, it's not clear. So I think that is very specific. But then last but not least, as far as Amazon and Google are concerned, we exited Amazon late last year in Q4, and then we exited Google. We've been reducing the Google position early this year and exited just before the summer. And for these two companies, more just about the macro headwinds, about the inflation narrative. If you're looking at Amazon e-commerce, then of course, we're spending a lot less money now in terms of buying discretionary gadgets and goods, just because our income are being squeezed. At the same time, for Google, it's just about digital advertising is going through some sort of headwinds when we are in a recession or when people don't have money to spend. So at some point, I think that would get resolved. And of course, if you look at the valuation of Amazon and Google, I think it's probably looking more attractive now compared to before. But I think we might still have at least a couple of quarters to go before we know when how the dust would have settled for this company.
Microsoft is still in the top 10. So why are you bullish on its prospects, given that you've sold some of the other tech companies?
So for the FANGs in general, so including Microsoft, that one thing that is another headwind for them is over 50% of their revenue are overseas from North America region. So of course, on the back of a strong dollar, and at the same time, Europe and Asia are not doing as well as the US, then you probably don't want to have too much exposure in this big tech company. And Microsoft is one of those as well. Is a big tech company, is the second biggest company in the world. But the thing that get us to continue to like Microsoft is because its business model is a lot more sticky and high quality. So if you compare the business model of Microsoft versus Google, one is done on digital advertising, which you can basically turn up and down in terms of your spend budget. So let's say we were spending maybe £1,000 a day to target our audience, and given the macro environment, given people are not buying new funds, that you could easily just turn it down to £100 a day. And of course, that would be a significant drop in revenue terms as far as Google is concerned. But for Microsoft, they have announced that they announced last year they're going to raise prices by about 15 to 20% this year from April in terms of subscription to Office 365. And as we all know, for professional workers like us, that our life or our work is very dependent on the Outlook, on PowerPoint, on Excel and all that. And it's just impossible for us to say no to Microsoft. And why don't we just consider another alternative, maybe the Google G Suite? I mean, no company would do that. And of course, at the same time, because the cost in itself is quite low, so we are still only talking about maybe $50 to $60 a month per head, which is not a lot compared to how much value that the professional workers would generate for the company. So I think unless that you think, which is obviously there's a possibility for that to happen, is there going to be a massive round of redundancies in the professional services, let's say in Europe, or at the same time, maybe some companies start to disappear, which basically people lose their jobs who are Microsoft users, then they would get impacted. But for the time being, it's just because the business model is very sticky, so that they can continue to hold on to the business they're doing. Of course, they have other things that's going on that's working in their favor. So when we look at the valuation of Microsoft and also the medium-term prospects, that we can still expect Microsoft to do quite well, irrespective of whether we go into recession or not. But that's not the same case as for Amazon and Google.
Just under half of the fund is in businesses that are classified as technology companies. Could you talk through some of the subsectors within technology that you invest in and name a couple of shared examples?
Yes, so I think the high level categorization of company being grouped into technology, that's a bit unfair or misleading. The thing that people always should know is like MasterCard, Visa, and Intuit, which is a software company for QuickBooks and TurboTax Live in the US. They are considered as technology company. But for us, they are considered as financial services. Of course, MasterCard and Visa, as we all know, they're the payment network. Like every time we make a payment, they would be making some money off us. And so of course, on the back end, is powered by technology. That is not people who actually do filing the invoices and making the payment itself is done by technology. But in effect, it's actually a financial services company, and same for Intuit. So I think for us, when we categorize many of the names that we have in the fund based on end market exposure, that we only have about a quarter of the fund in technology names. So the technology names that we have, that we categorize as technology, would be the likes of Microsoft, NVIDIA, ASML, which is semiconductor company, etc. But then equally, we also have other software businesses like Viva, which is a leading software company for pharmaceutical industry or biotech industry. We have Autodesk, which is the market leader for a software market leader for construction and manufacturing industry. So we would probably want to categorize Viva as a healthcare company rather than just technology, because the end market is healthcare. And at the same time, for Autodesk, it's industrial, because the end customers would be the likes of Balfour Beatty's or the house builders, architect, and some manufacturing facilities. And the last point I will make on this is just because the business model is much more higher quality, because it's software, it's subscription, it's recurring, then you would rather to invest into these software company who service the end market industry that are a bit more cyclical, because the margin will be quite low for those sub-industry. But then if you're the software company who is providing the backbone of how they operate, then it actually make them very high quality. So similar to Microsoft in a way that you want it to be the kind of the core of how the business is run.
Stephen, thank you for coming in. That's all we have time for today. You can check out the rest of our insider interviews on our YouTube channel, where you can like and subscribe. Hopefully, see you next time.